Let's talk about something that is going on here, though, in my neck of the woods, which is the Fed, because they're getting together. FOMC is meeting. This has become a ritual to talk about what the Fed may do to intervene further in the economy. I guess my question for you, to just get this out of the way, the last time you were on, you said you expected QE3 at some point, and now we've seen a lackluster GDP report showing the economy is just inching along at 1.5% on an annualized basis. Now, according to the price indexes from the GDP report too, inflation is below what the Fed is targeting. So does the Fed have enough ammunition to act?
Well, there's a whole bunch of other data that suggests that everything is already starting to shrink, so they don't really announce that data. But it means that they are on the verge of some sort of action like a QE3, QE4, QE5, and it'll continue. They're backed in a corner, and they really can't do anything else except, tell us that gold is money, that they have been wrong for the past 30 years, that gold standards are hocus-pocus, fictitious gold, and that we should be using real gold, and then quit and close up shop.
Quit, close up shop, go home, nothing to look at here, folks. Why is this the solution in your view?
They should stop messing around with the economy and skewing it one direction or another, creating all these bubbles, create a wealth transfer, creating a disparity between the middle class and the rich that is enormous. I believe that if we had used gold like we used to before World War I, not hocus-pocus gold standards with reserve ratios and national currencies, but just gold, we never would have had any of the pullbacks. Yes, growth would be slower, but it would be continuous. And with all of the technological advances and advances in efficiency that we've had over the last 100 years, I believe that our standard of living would be far beyond what it is right now if they would just let the free markets work and get out of trying to keep on trying to control the markets. All they do is skew the economy, pump something up into a bubble, which causes a wealth transfer. The bubble pops, and then everybody ends up paying for the bailouts through future taxation.
Mm-hmm. And I think you made a really interesting point, which is there's a difference between sustainable growth, which you're saying would have happened under your scenario, and just growth, which is boom and bust, and you don't know where this liquidity is going or what kind of bubbles it's forming. And then when it busts, that wasn't sustainable growth, that was a disaster. So I want to talk a little bit more about the impact of the Fed on the everyday person, because we talk a lot about savers and people living on fixed incomes and also the decline in purchasing power. But one argument I hear from people who say the Fed isn't doing enough is that one of the Fed's mandates is unemployment, and unemployment is still so high, so the Fed should act in order to help lower that unemployment figure. So what's your best counter argument to that?
Well, they create the unemployment. The Fed lowers interest rates. That means that it's cheap to go out and borrow currency for a house, a home mortgage. A whole bunch of people do that, and when they do that, it creates currency. When they take out a loan through fractional reserve lending, the banks get to create currency that did not exist. The highest purchasing power that currency will ever have is for the first person that uses it. After that, it's out in circulation. So what happens? All of these real estate investors experience this short-term boost in wealth. They've got a whole bunch of wealth. Anybody that did not participate in that boom, where they made wealth during the boom and got to use that currency first, the currency is in circulation and prices go up. Back in the year 2000, gasoline was $1.25 a gallon in Los Angeles. Now it's $4.50. So it's up about fourfold from where it was in 2000. So the people that didn't participate end up losing wealth because prices are high. They might be making the same amount or even a little bit more. But if prices quadrupled and they're not making 4 times the salary they were making 10 years ago, they lost ground. And that was a wealth transfer from them to the people that got to create currency, the banks first, and then the people that got to use it first and spend it into circulation, all the real estate developers and everything that were dealing with the banks. So it just creates a wealth transfer. It skews the economy and makes things lopsided. That bubble bursts and the whole thing falls apart. And then unemployment goes way up. The unemployment that we have right now is Alan Greenspan's fault more than it's Ben Bernanke's fault. And this kind of stuff will just continue the more people say that the Fed has to do something about it. That's the exact wrong thing. The Fed has to step out of the way. The government has to step out of the way. We need less regulation, especially on small business. We need to let the economy work. And all they do is put stumbling blocks in the way. And they make a few people rich at the expense of everyone else.
Yeah, and you bring up a good point, too. I'm glad you brought in Alan Greenspan, because there is enough blame to go around when it comes to central bankers, and sometimes the focus just becomes about Ben Bernanke. But, I mean, this is a legacy, and there's a legacy of other central bankers, too, which you're talking about. I think it's important to bring up. Since you mentioned banks and lending and fractional reserve lending, I want to bring up one of the things that the Fed has hinted it may do, that Ben Bernanke has said would be a tool, which would be to reduce the interest it pays on excess reserves, which banks hold at the Fed, which we know since the Fed began pumping all of this money into the economy, a lot of it hasn't gone into the economy. It's just gone right back to the Fed, where banks are stockpiling it to the tune of close to $1.5 trillion, when that number used to be just a tiny fraction of that in 2007. So what would the impact be of reducing that interest paid on excess reserves? Would that unclog the pipe so that this money gets out to the average person who's trying to take out a loan for his small business or for a home?
Who says where that currency is going to go, though? It's not money, it's currency, first of all. And we got to stop calling currency money. Money has to be a store of value. And that means that only throughout history, throughout time, only gold and silver are money. Everything else is national currencies. If you have a gold coin, you take it to any country on the planet, you can buy something. If you have a piece of paper with numbers on it, I can't buy anything in the United States with Chinese renminbi or Japanese yen or even euros. I can't pay for a cab ride. If you had gold, if we were using gold, anybody would accept it all the way around the world. But to get back to the question of not paying as high interest rates on the excess reserves so that the banks will free up. First of all, it's immoral for them to be paying the interest rates. The Fed created a whole bunch of currency by buying up assets. They bought up mortgage-backed securities. They bought up Fannie Mae and Freddie Mac MBSs, which is real estate that they're buying. And they bought a whole bunch of treasuries from the banks, U.S. Treasury bonds. The Treasury bonds are our national debt. That's what we have to be. A Treasury bond is a promise from the U.S. government, and whatever Treasury it is around the world, it's a promise from that government to tax its population in the future. So they're promising us that they're going to extract taxes from us in the future. That's what deficit spending does. They sell this bond. The Federal Reserve acquires it, and they buy that bond. They write a check. Here's $1 trillion, and they buy those bonds. That checking account there is no account. There's no balance there. They're writing a fraudulent counterfeit check to buy this thing, and then the banks they do this through open market operations. Now the banks have that $1.5 trillion they're talking about in their accounts at the Federal Reserve. And then the Federal Reserve is going to pay interest on it, which we have to pay in future taxation.
That's crazy.
Absurd.
It's passing all the money around. Mike, I'm going to stop you for just one moment. And if you hold that thought, I can get to it right after the break. I know that the question you just posed is one you've been trying to pose to Ben Bernanke, which is it even moral for the Fed to purchase assets with a checking account that has a zero balance? We're going to talk more about that in a few minutes with you. If you hold right there, Mike will talk to you on the other side of this break. Also, still ahead, what has Mike Maloney been trying to ask Ben Bernanke? I mentioned one question, but he'll tell us much more after the break. Welcome back. The FOMC meeting is going on today, and tomorrow we'll get a decision from them on the interest rate. No real surprise there, at least presumably. But we are talking about it with Mike Maloney because everyone kind of has their eyes on the Fed and also the ECB, wondering if and when they'll act, either readying for it or bracing for it, however you want to look at it. But before the break, Mike Maloney was in the middle of a thought and he wanted to finish it, so we want to get straight to him to see what that was. Mike Maloney, he's founder of goldsilver.com, author of Guide to Investing in Gold and Silver, part of the Rich Dad, Poor Dad series. And Mike Maloney, before the break, we were talking about your questions to Ben Bernanke. I know you guys have been trying to interview him for your very popular series that you do. No luck yet, but I know you want to know, is it even moral for the Fed to purchase assets with a checking account that has zero balance? That's your question for Ben Bernanke. Why is that really one of the very important things in your view? And you can finish your thought you had before the break, too.
Okay, well, to finish the thought first, you asked if they lower interest rates on the excess reserves that are held by the banks so that the banks will lend that currency. No, it won't help. Unless the Federal Reserve, the Federal Reserve came in right after that crisis and they raised all of the qualifications and regulations on the banks. They raised lending standards so that somebody that was broke, some bank couldn't dummy up documents and create a loan for somebody that was broke and was not financially literate. And anybody that fogged a mirror could buy a home then. A lot of people are like up to here in debt. The only way for that currency to go out and like stimulate another housing boom is to make lending standards lower than they were before. It's to bring back the subprime market, which is dangerous as can be, and they're not going to do it. So that currency will seek another home. Mm-hmm. And where is it going to go? Probably into commodities, precious metals. It'll cause retail price inflation. A side note, the true definitions of inflation and deflation: expansion and contraction of the currency supply. Mm-hmm. Something follows. There's a symptom that shows up somewhere. It's not always retail prices, but something inflates, like, for instance, the stock market, housing, or or commodities.
Yeah.
It goes several places.
That's a great point. The Fed can't control where that money goes, and it also can't control banks lending that money out, which is just such an important distinction, because what happens in theory, or should occur in theory, isn't what happens in practice, which is a point that I think is often missed. I really want to hear, though, Mike, what you want to ask Ben Bernanke, because these are important points, and I want to know why those are your key points. Okay.
But first, that 1.5 trillion, if it gets lent out, it's through fractional reserve lending. Mm-hmm. So under a 10% system, that could create 15 trillion of excess currency in the currency supply. In other words, an enormous inflation, except most deposits are under there is no reserve ratio. Once a bank has more than, I can't remember exactly what it was, 70 or 73 million, the loans after that first 73 million don't have a reserve ratio on them. Anyway,
great point.
To get back to the questions for Ben Bernanke that I've been trying to ask. In testimony to Congress, Congressman Ron Paul asked, "Is gold money?" And his reply was that no, it is not money. And then when Ron Paul asked, why do central banks hold so much gold, or why do they still hold gold, his answer was tradition. Mm-hmm. Well, my question then is, why do the central banks hold so much tradition, and why are they accumulating more tradition?
Yeah.
They're now net buyers of gold. I'd like him to
that's a lot of value given to tradition. It's a lot of value given to tradition. I think your other question, too, had to do with why can't we know who the shareholders of the Fed are? Why is this such an important distinction?
Right.
Yeah.
The Fed does have shareholders. Shareholders are the owners of a corporation. So there is a corporation that has been passed off as a government agency that has owners. The owners are the banks, so the banks own the institution that's supposed to regulate them.
Yeah, that's crazy.
Is that moral or immoral? Mm-hmm. The Fed buys assets like mortgage-backed securities, which is real estate, and part of our national debt, which is treasuries, which we have to pay tax on in the future, like I said, with these fraudulent counterfeit checks that borrow currency into existence and indebt us in the future. Does he believe that that is moral, for it to be able to create currency from nothing and go around buying up pieces of this country?
It's a great question. Mike, before we go, I just have a minute left. I really wanted to make sure I got to this because currency it's a debt-based system and there's not enough currency to pay the debt that's created. And I'm curious in this fiat system if you think that the LIBOR scandal has anything to do with an assessment of where the monetary system is. It was something we were talking about before the show.
The LIBOR scandal is all the banks know that this is a sinking ship and they're trying to grab everything they can before the game is over. They know that this system is coming to an end, and they're just looting the entire nation and trying to get out while they can. The world's fiat monetary system, you can see pieces of it starting to crumble now. We're about to go on to some sort of gold standard. When we do, gold's purchasing power will increase astronomically. But, you know, well, a couple other things I want to know. In 1913, Congress passed a constitutional amendment allowing income tax. Coincidentally, that is the same year that the Federal Reserve was passed by Congress, the Federal Reserve Act. So we didn't need income tax before the Federal Reserve, and with the Federal Reserve, we do. Is this just a coincidence? And then this debt-based monetary system where we borrow all currency into existence and promise to pay it back with interest means that we have to work in the future and pay taxes just to pay the interest on the currency that's in circulation today, the prosperity we're enjoying today. Is this a form of enslavement, and do you think this is moral? And if it is a form of enslavement and you think that it's moral, then you should stay where you're at. If you don't, quit and close the Federal Reserve.
There you go. Final words for Ben Bernanke. Yeah, you gotta introduce a new tax if you're going to pay for all that deficit spending. I really appreciate you being on the show, Mike Maloney. It's always very enlightening to talk to you. Mike Maloney's author and founder of goldsilver.com. Thanks so much.
Thank you.